Hello everyone, thank you for coming to my channel. Today I would like to briefly introduce two multi-policy transmission channels and provide you with some method to identify the multi-policy shocks in those two channels. First, I would like to address the question about what the multi-policy transmission channel is. As we all know that the Federal Reserve announced the multi-policy announcement right after the Federal Open Market Committee meeting, and then they will implement the multi-policy actions in order to fulfill their promise in the multi-policy announcement. However, the multi-policy do not directly affect the real economy. There are many market participants in the real economy and in the financial markets. For example, the household, firms, government, and the financial intermediations. So the monetary policy will affect the behavior of all those market participants and further affect the real economy. However, the transmission between the monetary policy and the real economy is in a black box, and we have a very limited understanding about what is inside in this black box, and that is why we need to propose some theories about the multi-policy transmission channels and use some empirical method to make some inference about what is inside in this black box. So, in the literature, there are three typical multi-policy transmission channels. So the first one is a Keynesian type interest rate channel. It is also the textbook view, and it will be something that we will learn in the principles of macroeconomics, intermediate macroeconomics, and even the macroeconomic theories. And the second channel is a credit channel first proposed by the Bernanke 1995 paper. And in 1999, the Bernanke and Gertler make it official as financial accelerator models based on the empirical evidence they find in the data. So in that channel, Gertler and Bernanke argue that the financial intermediation plays a central role in the multi-policy transmission channels. So in other words, the monetary policy affects the behavior of the banks, and then the behavior of banks will further affect the real economy. Based on the credit channel, the Borer and Zhu proposed the risk-taking channel in their 2012 paper. So they argue that the monetary policy affects the perceived risk or the risk tolerance of the financial intermediations, and then further affects the real economy. So in this channel, they argue that the perception of the banks also make an important inference about the real economy. Since the risk-taking channel is developed based on the credit channel, and it is inevitable to introduce the credit channel when we talk about the risk-taking channel. So in this video, I will put my focus on the Keynesian interest rate channel and the risk-taking channel. As to the interest rate channel, the monetary policy is equivalent to the changes in the federal funds rate. And that is why in the textbook we often consider the federal funds rate as a measure of the monetary policy. The monetary policy affects the long-term interest rate through the expectations theory of term structures. So it means that if the monetary policy change the federal funds rate, it will affect the people's expectation about the future path of the short-term interest rate. And since the long-term interest rate is composed of multiple short-term interest rates, so changes in the expected path of the short-term interest rate will affect the long-term interest rate. And And one thing we need to notice is that here the changes in the long-term interest rate is the changes in the nominal interest rate, but not the real interest rate. So the transmission from the nominal interest rate to the real one is based on the assumption of the sticky price adjustment. It means that the firms will reluctant to adjust their price when there's a changes in the real economic conditions. It is because of a lot of reasons. For example, the real cost of adjusting price, and the long process of the price adjusting decisions. So there are a lot of reasons, and we can summarize this sluggish adjustment of the price level to the sticky price adjustment, and it is a typical setting in the Keynesian type macroeconomic models. So changes in the nominal interest rate will directly affect the real interest rate because the price level do not change immediately. And eventually, the changes of the short-term interest rate will affect the economy through a cost of capital effect. It is according to the new classical theory of the new classical theory of investment. So in this effect, changes in the real interest rate will affect the spendings in the durable goods and the fixed investment. Since the consumption of durable goods and fixed investments are the most important indicator about the real economy, and then the changes in the real interest rate will eventually affect the real economic production. So in this channel, if we want to identify the monetary policy shocks, we can put our focus on the unexpected changes of the federal funds rate, because the monetary policy is equivalent to the changes in the federal funds rate. So if we want to know what is the unexpected movement of the Federal Reserve's monetary policy, then we can use the unexpected changes of the federal funds rate around each monetary policy announcement to indicate this change. In comparison, we can look at the risk-taking channel. In the risk-taking channel, the monetary policy can be multidimensional. So the monetary policy can be the changes of the federal funds rate, but it can also relevant to the forward guidance, the large-scale asset purchase programs such as the quantitative easing and operational twist. All those things can be considered as part of the monetary policy. And the monetary policy is equivalent to the entire information content of the Federal Open Market Committee announcements or the monetary policy announcements. And the monetary policy affects the long-term interest rate through the variation in the risk perception in the financial markets. So the reason we call this channel as a risk-taking channel is because we only emphasize the impact of monetary policy on the perceived risk of financial intermediaries. So when the monetary policy increase the risk perception of the financial intermediaries in the interest rate, and then in the financial market, the investor will dump the long-term interest rate because of a higher risk in the interest rate, and it will further push up the term premium of the long-term interest rate. And as to the transmission from the nominal to the real interest rate, we still use the sticky price adjustment. And lastly, the monetary policy affects the real economy in the risk-taking channel through the risk-taking behaviors of financial intermediaries. The risk-taking behaviors is a little bit harder to understand, but essentially it is a lending behavior of financial intermediaries. So if the banks reduce their volume of lending or maybe increase their credit premium on their lending rate, then it will affect the lending activities in the economy, and that will definitely affect the real production. So in this channel, if we want to identify the exogenous impact of monetary policy, we cannot rely on one specific monetary policy tools like the federal funds rate. Instead, we can find a variable that can reflect the changes in the interest rate volatility, and investigate how monetary policy announcement affect the interest rate volatility around each monetary policy announcement. So, and the difference between those two channels are twofolded. First, in the risk-taking channel, the monetary policy is multidimensional. It is not only about the short-term interest rate, but it's also about the unconventional monetary policy tools and other components in the very diversified monetary policy announcement. So it is a more comprehensive way to understand the monetary policy. And the second difference is transmission is a medium of transmission. So in the interest rate channel, the monetary policy affects the real economy through the changes in the interest rate level. However, in the risk-taking channel, the monetary policy affects the real economy through the variation in the interest rate volatility. So in the risk-taking channel, we look at the second moment movement of the interest rate. So it is a new way to identify the monetary policy shock, and based on the previous description, we can find that the interest rate channel and the risk-taking channel are actually very good complement to each other. One is about the interest rate level, the other is about interest rate volatility, and one is about the short-term interest rate, and the other is a more comprehensive way to understand monetary policy. So we think those two channels are a very good complement to get the whole picture about the actual monetary policy transmission to the real economy. And based on those two channels, we can derive a different way to identify the monetary policy shocks and investigate how those monetary policy shocks affect the real economy. And that's all for my today's presentation. And if you have any question or the comment, please leave it below the video. And